An FDIC takeover is imminent. I'm your host, Steve Van Metre, and thanks for joining me today. And we just got some breaking news before recording that First Republic shares have now been halted for trading. Let's over to Zero Hedge, who covers a story saying that their shares have crashed to record lows, now dropping at one point this morning as much as 30% as deal hope fades. Leaving the big question now is, will First Republic be the first bank to be in FDIC receivership? We could find out before market closes today, and if not, the question then will remain throughout the weekend is, at what point will the FDIC step in? Now, if you're wondering why their stock was crashing today, because in pre-markets it was actually up on hopes that there could be a deal as early as sometime this afternoon. But what happened is rumors started swirling that existing shareholders of First Republic could be potentially entirely wiped out if a deal was struck. And then in early trading today, what do we find out? There is potentially now no deal, sending the share prices plummeting. And now opening the question is, will the FDIC be stepping in to take the bank into receivership? And I'm sure we'll find out soon enough, because there's also other issues as we look into our stories today. We see that usage of the Fed's emergency lending facilities are now increasing, suggesting that there's even further stress in the banking system, also suggesting that First Republic may be the first of many banks to face the question of, will the FDIC take them over, as we start to look at the broad economy and continue to see signs of a major slowdown. Let's over where we pick our first story up of the day to Bloomberg. As Fed's crisis dollar sales pared back as global tensions subside. And where I want to start today's show out is for you to understand what the problem isn't. And then we got to get into what the problem actually is with the banks, because during the recent crisis, the Fed increased the frequency, along with some other central banks, of its swap lines, thinking that perhaps there was a dollar shortage. And then quietly this week, all of a sudden they say, well, we're not going to need to run these as often. We're going to go back to our weekly scheduled draws if anyone needs them. But for a while here, we've had them every day, because the problem, as the regulators can't see, it's not a dollar shortage, at least not today. In view of the improvements in U.S. dollar funding conditions and the low demand at recent dollar liquidity providing operations, the Bank of England, the Bank of Japan, and the European Central Bank, along with the Swiss National Bank, in consultation with the Federal Reserve, had jointly decided to revert the frequency of their 7-day operations from daily to once per week, which was the standard from before. And here you can see there wasn't a dash for dollars this time. This chart provided by Bloomberg. We can go back and see at points in history where there's a huge demand, a huge dollar shortage, and everyone needed that liquidity. But here you can see when they introduced those daily swaps, well, there was almost no demand. There was almost no issue, because the problem facing the banking system, much to see that the regulators can't figure this out, is it wasn't a dollar shortage. It was actually something much worse. We're going to get into that here in a moment, but let's dig a little deeper here. The reactivation of such joint measures, first used during the global financial crisis and deployed during the pandemic, demonstrated how the central banking community's financial stability infrastructure and cooperation remains robust, not bust, but robust. The Fed and its counterparts will revert to greater frequency if needed. So you have to love this response. It's kind of like, hey, we've got a bunch of superheroes here of the central bankers, and we stand ready to provide liquidity at any time, and we are all lockstep together here, and if we need it more often, we'll do it. And certainly no one needed it, because that wasn't the problem in the banking system. And what kind of alleviated this pressure on the need for these swap lines? Well, it was simply because the dollar started to weaken. And we can go back now and take that same chart from Bloomberg. We can overlay the central bank liquidity swaps against the nominal broad US dollar index, and we can see, going back to the global financial crisis, there was a huge surge in demand for dollars because the dollar was strengthening, and that was an indication of a dollar shortage there. You can see that happens again here during the pandemic, as everyone was looking to get to dollars for safety. And here's that little blip, and what happens ever since then is, of course, the dollar has weakened. And of course, we can look at a number of different ways, but broadly speaking, when global trade is slowing, when demand is slowing across the world, well, so too is a need for dollars. We can also look at the fact that some people are taking their dollars and putting them in investment vehicles, opening the door that there is now plenty of dollars, so to speak, in the system available, taking pressure off the dollar here. So the issue facing the banks, much to the regulators' hope that it was something that they could solve, well, it wasn't that at all. And now we're seeing, of course, the bank bailout facilities get hit pretty hard again. And this from Zero Hedge. Bank bailout facility usage soars for the second straight week as money market inflows resume. And following the unexpected outflow the previous week, this week money market funds resume their trend with a 53.8 billion inflow. So what's happening here is what we should be seeing. If this banking issue was going away, what we should see is these emergency facilities the Fed made available. We should see the usage of them start to shrink down, because what tends to happen is during a crisis, people borrow more than they need from these facilities, and then as things subside, they start to pay it back. But now we're seeing those trends head up at a time when First Republic looks to be near insolvent. And what is the cause for this? Of course, the Fed can't see it with their own eyes because they're too worried about liquidity swaps. But here we can see the overnight reverse repurchase agreements. These are money market funds backstopped by the Fed. Now, there's probably around $5 trillion in money markets, and we can see the Fed sitting on around $2.273 trillion of that, being one of the biggest backstops of the money market space, because they're offering a whopping 4.8% interest on these overnight reverse repo rates. And we know they coming on Wednesday of next week, we're going to have an FOMC press conference and a public announcement that's likely the market is expecting a 0.25% increase here, which means, of course, that overnight repurchase rate is going to go up, potentially putting more stress on the banks as depositors start to look around again and saying, look, could my bank be the next First Republic? Well, maybe I should go shift some money into money market, particularly since the rates there seem to be rising at a point when my bank, they can't raise rates if they wanted to. But now let's take a look at what's going on in the Fed's balance sheet. Because looking at the actual reserve components, this continuing from Zero Hedge that were provided by the Fed, we find that the Fed backstop facility borrowings rose again, and this shouldn't be happening. See, you can see on the chart here, this decline here, this is exactly what you want to see if stress in the system is going away, that the last 2 weeks it ticked up from 144 billion to 155.2 billion, and almost back near, of course, the highs during the crisis there. But it's not just that. The usage of the discount window rose by 4 billion to 73.8. Now, we're not seeing this dramatic move here, but notice the decline. You see the discount window pretty much hardly ever used. Big spike. What we should see is the decline here, and this heading all the way back down to zero. That would be ideal, but now starting to trend back up to usage of 73.8 billion, along with the 8 billion increase in the usage of the Fed's brand new bank term funding program. That now up to 81.3 billion from 79 billion last week. Meanwhile, other credit extensions consisting of Fed loans to bridge banks established, get this, by the FDIC to resolve the Silicon Valley and Signature Bank issues remained relatively unchanged. Of course, the question now is, if First Republic fails, well, will that lead to even more money being lent to the FDIC by the Fed to handle it? Well, we can probably expect that's the case. But see, the banks are facing issues that the Fed can't see. And one of them, again, is the fact that they keep driving rates higher when banks are sitting on these unrealized losses from these low interest rate assets and loans they have. But that's not the other issue. We touched on this the other day. As a money supply, seen here in the M2, is contracting at an annualized rate of 4.1%, which is historically unusual. This is the third time in the tracking of the M2 that we've seen it contract. And when you're talking about the banks who need deposits right now, they need money to flow in. And so when we see money flowing out to money markets, where do we expect it's coming from? Bank deposit accounts. We need that money to flow back to the banks, because not only is it we've seen the problem is in the money market space, but the fact that what the money supply is telling us is that money is being destroyed, is going away, because there's not enough new lending, not enough economic activity going on to create enough new money to keep the system going. So you've seen the banks get hit twice with outflows due to the Fed backing the money markets, on top of the fact that money is simply being destroyed, because as money goes to pay back debt, it's destroyed. Again, we come back to the fact that there's not enough economic growth and not enough new lending to actually cause the money supply here to grow. And as we look around, we find out that the economy is indeed seeing further signs of a slowdown. Let's over to the Kansas City Fed, who's the 10th District Manufacturing Summary. This just came out the other day. They noted that in their manufacturing district, activity declined moderately in April. So again, not something we want to hear. The decline was driven more by non-durable good plants this time, especially printing, plastics, paper, and food manufacturing. Remember, we've seen a lot of food inflation lately, so this comes out a bit of a surprise. And all month-over-month indexes declined, except for raw material prices. So you're seeing input prices still up, finished product prices, which would make sense if raw material prices are higher, average employee work week, which is nice that expanded a little bit, and supplier delivery times. But broadly speaking here, we're seeing, again, moderate declines. Now let's look at some of the survey responses, because there's one of them that really kind of just puts the nail on the head of this thing, or the head of the nail, or hammer on the head of the nail on this deal. Is inflation is killing my business. Everything is up, and it's hard to get my price increases passed along to consumers. Employees are hard to find. Here's another one. Continued focus on improving operations in effort to grow without increasing the number of employees. So again, you see automation here, but the story is inflation is killing my business, and we're hearing this more and more. And then, of course, today we get some data from the Fed on their preferred gauge of inflation called personal consumption expenditures. Inflation gauge watched by Fed shows prices still rising while consumer spending stalls. And simply state the obvious here, we know why consumer spending is falling, because wages still aren't keeping up with inflation. But for the first time, we're actually seeing a change in that too. Let's take a look at what happened here. Is the personal consumption expenditures price index excluding food and energy, which would be the core PCE, the Fed's preferred measure of underlying inflation, rose 0.3% in March from the prior month and 4.6% from a year earlier. The Fed targets, of course, a 2% gauge, suggesting that they're going to raise rates. But here we can see personal consumption expenditures in blue against the core PCE in red. And kind of what we're seeing in that article is they're saying, look, the core PCE is remaining elevated up here. And so even though the headline PCE is falling, we expect that that's going to reverse direction. But you'll notice there's this green line, that's crude oil prices. Again, we talk about personal consumption expenditures. We're more focused now on the input side of the factory and then the output side as well. And crude oil is saying, look, I understand you're elevated here, but the reality is both of these numbers are coming down. The issue has always been and will be that lagging indicators do not fall as fast as policymakers want them to. Meanwhile, the Labor Department's measure of employment costs, also closely watched by the Fed, increased 1.2% in the first quarter, exceeding forecasts. The price data, especially in conjunction with rising labor costs, reinforced forecasts that the Fed policymakers will indeed raise their benchmark rate by 0.25% on Wednesday. While annual inflation appears to be peaked, the path back to the central bank's 2% goal is proving bumpy. Well, it's just a slow process, and that's what it takes. It just takes time, but we're still seeing the fact that for now, wages for the most part have been behind inflation. We're seeing now for the first time that's changed, but one of the issues here for most consumers is too little, too late. While a strong labor market and excess savings have provided households with the wherewithal to spend, consumers are beginning to lose steam. Well, they just can't afford to keep up with high prices. Personal consumption expenditures adjusted for prices stagnated last month, reflecting a pullback in goods spending and tepid outlays for services after a downward revised 0.2% drop in February. Because again, it was only a matter of time before we start to see the effects of the fact that prices are growing faster than wages, and then people don't want to borrow and perpetually borrow to try to keep up with them if they don't see their path where their wages are going to actually get caught up and surpass price increases of goods and services. The pullback in consumer spending suggests households are growing more guarded. Well, they just don't have the money and cutting back on discretionary purchases, as I mentioned the other day. While a strong labor market, persistent wage growth, and excess savings have bolstered consumers in the face of rising prices, we can argue that that isn't the case. The data implied that momentum is fading. What it's implying is that consumers are just tapped out. But check this out. When we look at the average hourly earnings of production and non-supervisory employees on a year-over-year rate of change against the personal consumption expenditures, for the first time now in a while, we're actually seeing that wages are actually growing faster than prices. But because there was this longer period here where they weren't, well, the issue then becomes is now consumers are having to dig out of a hole at a time. What are we starting to hear a whole lot of? Well, that second round of layoffs, a few thousand here, a few thousand there. Yes, that's all going to add up and suggest that not only is demand going to continue to fall, but likely that First Republic won't be the first bank if it goes under FDIC receivership from this crisis. It'll be the first of many. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.